Thanks so much for tuning into this earnings conversation with Bharat Forge. Their numbers came out just a few minutes ago. On all counts, they've beaten estimates. Revenues up 36% at 3877 crores. Estimates were way lower at 2,500 crores, if I'm not wrong. EBITDA growth. Margins improved from the YOY number as well as the exit margins of the last quarter, though the estimates were maybe a bit higher. But the net profit at 150% higher at 297 crores. Estimates of 255 crores. Amit Kalyani should be a happy man. He joins in right now to talk about what went right in the quarter and the outlook for the quarters ahead. Amit, good having you. Congratulations on a strong quarter.
Thank you, Neeraj.
The beat on the revenue is just a very large number and a 36% growth in quarter one. Did you pencil in for this when you started off the quarter, or have there been some positive surprises along the way?
So there have been several factors that have contributed to this, and largely it is coming from our standalone business. Also, our overseas business is turning around. We've had a good performance in Europe, and we expect the US to correct by the end of Q4. So if you look at some of the pieces, in the India standalone business, we had a growth of 21% on sales. We had sales of about 2,127 crores. On EBITDA, we had a growth of about 20% to 553 crores. PBT grew by about 27% to 421 crores. We've also won about 200 crores of new business. We have also signed up some long-term contracts with our existing customers, and our balance sheet continues to remain strong with a significant amount of cash on the balance sheet, including net of long-term loans, cash positive situation of about 700 crores. Passenger car story continues to unfold on the export side, where we've seen a 43% growth YOY. And despite the destocking in the oil and gas sector due to some product design changes, which have had a significant impact of about 80 crores in the quarter, the impact on the industrial business was limited due to a strong pickup in the aerospace business, which is on track for a healthy double-digit growth this year and a double-digit growth next year as well. And aerospace is now contributing to about 16% of our export revenue in industrials. In addition to this, I would say the cherry on top of the cream on top of the pudding really was our defense business, which has now matured and is starting to contribute healthily and significantly. We've begun exports of our defense equipment, and we've recorded sales of exports this quarter, and this will continue and continue growing in this quarter and next quarter. Additionally, we have also won orders worth almost 280 crores in Q1 from multiple customers and product segments in the defense space. So cumulatively, our defense order book now stands at well in excess of 2,000 crores, probably 2,300 crores or somewhere in that regards. So basically, this marks the transformation of Bharat Forge from a component player into a system player in one significant area where we invested over the last 12 years. And this is now the beginning of a secular growth phase in that sector. In the overseas business, we had a good EBITDA in Europe of about 51 crores as against a loss of 14 crores in the previous quarter. In US, we had a similar loss to last quarter, but I think subject to the demand being remaining solid, we will turn this around by Q4. In our casting subsidiary also, we're growing. We've won a lot of new business in the last 1 year, and we're now going to ramp that up over the next 2 years. We also completed the acquisition of Indo-Shell Mold SEZ plant for about 55 crores. This will allow us to close to double our revenues in the next 2 to 3 years in the casting business. Also, this is very close to our existing casting facilities, less than 2 kilometers away. So management bandwidth and oversight will be more or less common, and you will see benefit of efficiency of scale and operating leverage come in over here. In terms of our last man standing strategy, it's bearing very good results. We have signed long-term LTAs with most of our key customers. We also won new customers, and we are undertaking a fairly large and diversified capex program in India to take advantage of the India manufacturing opportunity and grow our manufacturing footprint, revenue, and exports from India over the next 3 to 4 years. And this will be across sectors, across segments, right from conventional forging, machining, aluminum forging, products for EVs, in metal and in other sectors, including defense. And once these capacities come online over the next 2 years, this will give us a very big jump in terms of our addressable market size and the capacities available to address these. And I'd like to highlight that all this will happen through internal accruals while maintaining a very strong balance sheet and a healthy debt to equity ratio. Also, as we progress ahead in FY24, we expect to see our consolidated EBITDA margins to increase from the current 16% significantly towards the kind of targets that we've set for next year, heading towards 18-19% and above, and a strong improvement in our return ratios.
Okay. Well, lots of follow-ups. We'll make this quick because I understand you have short time. Let me start with the last point first. This improvement in operational metrics, is it a factor of input costs coming off or a mix of efficiencies and utilizations moving up or a combination?
It's more of utilization, efficiency, cost reduction, some amount of input costs coming down also. But input costs have become very skittish right now. Anything can create input cost issues. Even some threat of something happening in the future can create these issues. So I think you have to build a business model to insulate you from these kind of vagaries.
Okay. Whatever happens around the quarter, if it's good luck, then great. Okay. I heard you say that the global businesses have done well. Now you're a bunch of those things. Tell us what part of the global business has done well, because it seems counterintuitive. Europe is not exactly strong. US is strong, yes, but I'm wondering what part of the business has done well. Is there something that you expect to do well going ahead?
Yeah, so in Europe, we've done a lot of work on efficiency improvement, cost reduction, and basically improving the throughput. We had an existing business, plus we had made some new investments over the last 3 years. Those investments are now starting to mature and head towards 40, 50, 60%, 70% capacity utilization. And as they head to those kind of numbers, then you start seeing, the flow down into EBITDA, PBT, and below. So that is something that you will see continuing over the year, and we will have a PBT in Europe for sure. In the US, our new plant, which is just about less than a year old, is in a ramp-up phase. By December of this year, it should be, let's see, all the approvals and the product development should be complete. And then in a quarter or two, we should start seeing positive numbers, both at a EBITDA and a PBT level.
Got it. Amit, back in Davos as well, you're hopeful of the global piece not turning out too badly. As things stand, when you talk to your customers and to your company managers, as the case may be, what is the sense that you get about global demand?
So global demand is strong. If you look at Europe demand is driven by some unexpected characteristics, plus a lot of efficiency improvement in the supply chain and the transport value chain. There are very few drivers. Drivers don't want to drive old trucks. If you want to transport goods, both for efficiency, emissions, and attraction of drivers, you need newer trucks.
Okay.
Plus, they have now the new Euro 7 norms coming out. In the US, you have a lot of infrastructure development that is taking place. Plus, the fleet is old. There is still a lot of demand. And, there's going to be a new carb emission norm before which people want to buy trucks. So there's going to be a sustained demand for 23 and 24. So these are some of the factors that are driving these markets. And, at the end result of all this, that we will have more demand in India.
Okay. I want to end with the capex details, but before that, two quick questions. One is on defense. At the end of quarter 4, on the con call, you had said that your order book was 2,000 crores. You've bagged some more orders. On the defense piece, you've also been granted a license, if I'm not wrong, on the small, under the arms rules as well for small arms. Tell us a bit about how this is shaping up.
So, over the last 12 years, we've developed our own products. And as you're aware, this is not an easy business. This is a business that requires a lot of patience, a lot of, testing, validation. But I must say that the whole system, including the ecosystem within India, is very supportive of defense, not just localization, but also exports. And that is really what has contributed to the kind of exports that we're getting. couple that with the prospective orders that we see coming forward from India going forward, I think we see a lot of opportunity. And I believe that we are now turned the corner on the defense business, and this will now become a meaningful share, a double-digit share of our overall revenue going forward as a company. And I think that's a very good sign, and it can only go up from here.
Okay. Aerospace, splendid growth in FY23. You were hopeful of 30 to 50% growth. I heard you mention aerospace being a key export driver. Has it lived up to that billing? Do you expect it to continue to be the same in the quarters ahead?
It's taken us a long time. If you remember, even 5 years ago, I said, when a business hits $40-50 million per year, then you can create a line of sight to 100+ million. I think we today have a platform by which we can get to 100 million very shortly. So in the next 2 to 3 years, I think we should be at those kind of numbers. And this is another business which is very complex, very critical, safety related, and needs a long approval and testing cycle. And I think we are behind a lot of it in the current products we make, but because of the kind of performance that we've delivered and the way we've serviced our customers, we see a lot more opportunities, and this also will become a meaningful part of our business in the next 3 to 4 years.
Okay. If you have time, I'll ask about
I'd like to mention one more thing, is that we don't need any additional capex on the forging side for our aerospace business. We will need machining capex, which is dedicated or which is, say, specialized, but that is specialized for aerospace across a series of products.
Got it. Okay. If you have time, I'll ask about capex. But before that, just one key question, because you did about 20-22%, whatever it is in number terms for FY23 or FY22. You started off Q1 and you've started off FY24 with a bang with 36%. Maybe you can't replicate all of this, but I'm trying to understand what is the expectation for FY24 after such a splendid start?
I think this will be a good year. This will be a year when Bharat Forge demonstrates its ability to grow and will be driven by not just the tailwinds in the market, but also a lot of our strategic steps that we have taken, our positioning with our customers, our ability to develop new products and to service demand rapidly. So I think we have a lot of special things in place. We have a lot of factors that are driving our growth, and I think that you will see that panning out quarter over quarter.
But is 36% good or better than 36% good?
36% is great. It's not always possible, but I think we will see a very healthy growth.
Okay. Do you have time for the capex thing? Because you mentioned about it in that it's going to be a large capex drive spread over 3-4 years. Maybe you can just give us some details about it.
Yeah. So over the next 2.5 years, 2 to 3 years, we will spend roughly in the area of about 1,000 crores. And this is including defense, this is including EV, this is including forging, machining, all these areas. And as you are aware, defense, we have already a big order book. So we're spending about, we're setting up a new plant, an entirely new greenfield location with over 400,000 square feet of manufacturing space, which will address all the sectors of defense that we are present in, which is basically at the system level. So it will produce specialty vehicles, artillery guns, mounted gun systems, and many other things.
Wishing you all the best for this and more. Amit, thanks so much and congratulations on a splendid start to FY24.
Thank you, Neeraj, for always being positive. Thank you.
No, a pleasure is ours. Viewers, thank you for tuning into this interaction.